So you want to own a data center. Most people think owning one means buying a warehouse full of blinking servers, signing a few corporate clients, and collecting rent checks for rack space the way a landlord collects rent for apartments. Steady, boring, recession-proof, the kind of business you set up once and let the checks roll in. That part is roughly true, except before any of that, you need to understand something the data center industry almost never tells aspiring owners. According to Axis Intelligence Research's 2026 construction cost analysis, a fully built-out AI-ready facility now costs roughly 3.30 times more per usable megawatt than the standard shell and core building most people picture when they hear the words data center. That number is not a rounding error. That number is the entire reason so many first-time owners get priced out before they ever plug in a server. Startup costs. Let's talk about what you're actually spending, because the range is enormous, and the industry likes it that way. According to JLL's 2026 Global Data Center Outlook, the average global shell and core construction cost sits at $11.3 million per megawatt in 2026, up 6% from $10.7 million the year before. That's before you've turned on a single server. Land and utility interconnection alone can run $5 million to $25 million or more per Terrapin Consulting Group's 2026 Regional Cost Survey, and that's assuming your site even has spare grid capacity. A growing number don't. Powered shell electrical and mechanical systems, the transformers, UPS units, and switchgear that keep your facility alive during an outage, eat 40 to 45% of total construction cost, according to the same survey. Cooling, especially if you're chasing today's high-density AI tenants, takes another 15 to 25%. Licensing, permitting, and the compliance audits your enterprise clients will demand, SOC 2, HIPAA, the works, typically run $4,000 to $5,000 a month once operational, according to industry financial modeling from Financial Models Lab's 2026 data center hosting benchmarks. Add working capital to cover 12 to 18 months of operating expenses before you hit meaningful occupancy, because empty racks generate zero revenue and full overhead. All in, a modest 1 megawatt retail colocation facility built into an existing building runs $10 million to $14 million. Push into AI-optimized territory with liquid cooling and higher power density, and Terrapin puts that same megawatt at $15 million to $20 million plus. Scale to a real multi-tenant facility, and you're in 9 figures before you've signed your first client. So the question becomes obvious. Why would anyone put 8, 9, sometimes 10 figures into a building before knowing whether a single tenant shows up? Here is the part that catches almost every first-time owner off guard. This is not really a real estate business, and it is not really a technology business. It is a throughput business wearing a real estate costume. Once your electrical and mechanical backbone is built, your marginal cost of adding another tenant's rack is small compared to the rent you charge for it. That's why Financial Models Lab's 2026 hosting profitability analysis puts gross margins at roughly 93% right out of the gate. The power, the cooling loop, and the physical shell are largely fixed costs, so almost every additional dollar of colocation revenue drops straight to gross profit. The catch, though, and it is a real one, is that fixed overhead is so heavy that EBITDA can run negative in year 1, around negative $732,000 by that same model, before flipping positive as utilization climbs. This is operating leverage in its purest form. Your building doesn't care whether it's running at 20% capacity or 80%, but your bank account absolutely does. That's why operators obsess over utilization thresholds, typically targeting 70% occupancy within roughly 18 months, because past that point, EBITDA margins can push above 20%, according to the same modeling. Layer in managed services, monitoring, remote hands support, security compliance packages, and you're stacking high-margin recurring revenue on top of a facility whose core costs barely move. Now the sobering part. You will sometimes hear that a huge share of small colocation and edge facilities fail within their first few years, a figure some vendors quote to justify managed service upsells. And that figure is generally considered an overstatement by most analysts, in the same way the infamous 81% first-year restaurant failure statistic gets thrown around without context. What the data does support is more specific and arguably more dangerous. Utility interconnection delays are brutal. Sites with spare high-voltage grid capacity, according to Terrapin's 2026 survey, are increasingly scarce in primary markets, pushing some developers to spend an additional $3 million to $10 million per megawatt just building their own on-site power generation. Labor shortages compound this. Markets in Markets' 2026 colocation report found the U.S. industry employed 4.7 million professionals, yet roughly 300,000 specialized roles, from power engineers to liquid cooling technicians, were projected to remain unfilled, delaying builds by 6 to 12 months and driving wages for AI-ready specialists by as much as 30%. Then there's tenant concentration risk. A facility built around one or two anchor clients can be devastated if either leaves, and like a gym or a laundromat, you cannot quietly retrofit a half-empty data hall into something else. And finally, underinvestment in redundancy. Edge facility operators surveyed for 2026 industry research reported that cost-cutting measures increased their risk of unplanned outages in 62% of cases. And in this business, one bad outage can cost you the enterprise contracts that justified the build in the first place. So let us run the actual numbers on two realistic versions of your data center. Option 1 is the boutique retail build, a single 1 megawatt facility retrofitted into an existing building, all-in construction cost around $11 million. You price your co-location space at roughly $250 per kilowatt per month, a mid-market retail rate. In year 1, you're nowhere near full. Occupancy might sit around 25%, and with $732,000 of negative EBITDA baked into the model, you're funding losses out of your working capital reserve. By year 3, if you've hit your 65% utilization target, your annual revenue lands around $1.95 million. At a 93% gross margin, that's roughly $1.8 million in gross profit. But after fixed overhead, staffing, and compliance costs, your realistic EBITDA lands closer to 20% of revenue, call it $390,000 to $450,000 a year in profit. Modest on an $11 million investment, but it's stable, it's recurring, and it compounds as multi-year lease renewals lock in. Option 2 is the scaled AI-ready play, a 5-megawatt facility built for high-density liquid-cooled workloads, all-in construction cost somewhere between $75 million and $100 million. Once you factor in the AI premium, JLL and Terrapin both flag for 2026 builds. Here, demand runs hotter. AI tenants pay a premium for density and reliability, so you're pricing closer to $400 per kilowatt per month, and utilization at stabilization can realistically hit 80% because scarce power capacity means the tenants who do commit tend to commit hard. Run the math, 5,000 kilowatts at 80% utilization and $400 a month works out to roughly $19.2 million in annual revenue. At a 90% gross margin, that's about $17.3 million in gross profit. And with operating leverage kicking in fully at this scale, a 35% EBITDA margin is achievable, putting annual profit around $6.7 million. And the ceiling is still higher. Publicly traded data center operators like Equinix and Digital Realty, running at massive scale with decades of tenant relationships, routinely report EBITDA margins in the 45 to 50% range, proof of what this business looks like once the operating leverage fully matures. So here's the honest version of the pitch. That 3.30x AI cost premium that scares off first-time owners before they ever break ground is the exact same premium that lets the operators who survive the build charge rates most other commercial real estate can't touch. Not bad for an industry most people still picture as a windowless warehouse full of beige boxes and hum. If you found this video any helpful, please like and subscribe.